Welcome to TheoTrade. This is Don Kaufman. Here we are. It is January 23rd, 2017. We've got just about 10 minutes remaining in the trading session here. You were watching the Theo Night video. Let's kick it off this evening with talking about what I would term the tale of two markets. So what you're looking at right now, again, with about 10 minutes left to trade in the day, as the S&Ps are down 3. Why do I call it the tale of two markets? Well, this is a 10-day, 20-minute chart. Now, not all of you may watch intraday trade, and that's A-okay over here, no problem whatsoever. But allow me to zoom in on specific days and what I kind of call the tale of two markets over here. Now, this S&P chart includes after-hours trades, so kind of bear with me here. Here's today's trading session. We dip hard, we rally towards the close. Okay, that's what I call the tale of two markets. Here's previous week, last Friday. We trade down throughout the course of the day. We get bid up. We rally towards the close. Need I go any further? Yeah, why not? Now we're on Thursday of last week. Well, we sell off during the day. We get bid up towards the close. Okay, we could continue here pretty much. Well, I've got 10 days of data. We sell off, we get bid up. We get bid up the vast amount of the day. Wait, we're not done over here. Here, we actually make a true and valiant effort to sell off, and this is Tuesday of, again, last week, and we get bid up into the close. Now, you can't count Monday. That was MLK Day, so the markets were relatively speaking closed. Okay, so here's Friday. Woo, look, we rallied, we sold off, and we got bid into the close. Here we are again. Now we're 2 weeks back. We sell off what looks like it's going to be a hard down day, get bid for the most part of the day. Okay, and again, I can go back. All right, again, I'm on a 10-day chart over here. Each of the last 10 days getting bid up. All right, again, here's the prior Tuesday. All right, here we go. We finally found one. 1 out of 10 trading sessions we did not get bid into the close. Nevertheless, here again is today's trading, and we sell off. Looked like it was going to be a decent sized down day. We get bid towards the close. Now again, with a few minutes left to go, possibly some weakness coming into the market. Nevertheless, you have to wonder how many times in a row can this ultimately occur over here, that you're looking at 9 out of 10 trading days, the market's ultimately getting bid up into the close. Today specifically, if you're looking for where was the strength in the marketplace, well, first and foremost, I'll show you where some of the weakness was inside of the financial strength, though. Very specific today. Google breaking out to, well, all-time new highs. Yet Google this Thursday is going to have earnings. Is it getting bid up prior to the earnings announcement over here? Does this have anything to do with whatsoever? You know, if you looked at Qualcomm today, Qualcomm's down a pretty handy amount, given the fact that they had a major lawsuit from Apple. Doesn't seem to be impacting Apple. You've also got Facebook. That's earnings are next week, getting bid higher on really, I think, some of the coattails of Google. Now, neither here nor there. I mean, when you're looking at the markets and you step back from this, and we'll just talk about the most previous 10 days or 2 weeks of trade. As I said, it's a tale of kind of two markets, this bifurcated marketplace where, again, if you look towards the financials, they seem to kind of be waning a little bit. Here's ultimately what we'll term the president-elect rally over there. This is the election rally, and the financials are fading a little bit. The tech is doing the exact opposite. Technology, once again, hitting all-time highs last Friday, just a hair off of all-time highs today. But again, all of this is neither here nor there. Everything, for the most part, is scattered. It's pretty sloppy trade over here. Even looking at the bond market, you get a day we're down hard, a day that we're bid up. You're taking a look, again, at the XLF. You're seeing the XLF fade over here. If you're looking at some of the tech stocks, they're as strong as can be. They're all-time highs. All right, energy, well, it's caught somewhere inside of the middle over here, but having a little bit more of a sell-off today. Again, from sector to sector, all over the place. Ultimately, what we're not seeing is strong confluence throughout. We're not seeing a heavy correlation. There is one kind of overriding theme, though, and many traders have been pointing this out to me, and I'm going to reiterate this to you as well, because I've had a tremendous number of questions about it. It deals with something called Skew. Okay, so this is the only, like, I guess, overriding factor to the entire marketplace, which has been scattered, kind of some sloppy, trade in, again, the most recent 10 days, 2 weeks out there. I'm going to go to style for just a moment, and I'm going to load up what is termed a line chart. Skew is only calculated at the end of every trading day. So for the most part, if you've never looked at skew before, it's neither here nor there. It's fine. Okay, as I showed you, a lot of sloppy trade recently, maybe something a little bit more definitive, and that's what we're going to try to provide here with looking at the skew. So the skew, again, before we've even explained what it is trading, roughly speaking, at about 146. Now, if I just drag a line right to the 146 level, okay, now all we have here is a chart ever since the skew has been calculated, and that's back into 2012, 2013 time horizon. Over here is when they started calculating skew. We have roughly 1, okay, that's 2, 3, we'll call this 4, maybe 5, 6, okay, and this would be about the 7th occurrence of skew being this level. Now, what is it? I mean, really, what is skew? What skew deals with is specific to the SPX. Okay, I'm going to open up approximately the 24-day options in this case. What skew really deals with is we're going to open up a ton of options in this chain. Okay, open up, again, almost the entire chain. Take a look at sometime the out of the money implied volatility. Now you have to recognize I'm at options of the 1900 strike here. 1900 strike, and we're trading almost 2260. So again, you can see how far out of the money we are. Well, you can see the implied volatility is about 28%. Now, we'll tune in a little bit closer to the money, to something that's a little bit reasonable. If you go in this case to the 2100 strike, we're still trading at about an 18 volatility. Okay, neither here nor there. If you're not familiar with volatility, you probably have no idea what it means. Well, the out-of-the-money puts are trading for an 18 volatility. I'm going to scroll for a moment. We're going to go look at the out-of-the-money calls. Okay, you can look at calls that are equidistant out of the money, and you're going to see that their volatility is what? It is less than half of the out-of-the-money puts. So what this means is there's this drastic demand for puts. And a lot of times, those puts are financed, okay, by selling out-of-the-money calls. This is and has been turned into an index called Skew. That's SKEW. And what the Skew measures is the differential of these out-of-the-money puts versus the out-of-the-money calls. And again, since the Skew has been tracked, it's most notable that, well, what we're seeing right now has only occurred a handful of times. So this kind of begs the question when we start looking at something like skew. Let's tighten up the time frame over here to just 3 years. Now granted, this is the SPX. Okay, so we're looking at the SPX. On top, okay, we're going to have just the SPX. On the bottom, I'm going to go ahead and I'm going to type in skew. Once again, with skew, I've got a style pre-built in here where it just changes it into a line chart. I got to compare apples to apples, so I want to make this a 3-year daily. And I felt, hey, look, this is the highest skew kind of ever recorded right in this neighborhood here, okay, of a 153 skew. Now, I'm looking purely over the last 3 years. And if you see the highest recorded skew, okay, we'll kind of zoom in over here. You'll actually see markets dipping at the same time. Let's zoom back out for just a moment of both charts. Okay, so it's a high instance of skew, fairly large dip in the marketplace. Okay, here's another high instance of skew, and this was in the beginning of 2016, but the market was in the midst. Again, at that time, the market was in the midst of a fairly substantial sell-off when skew was kind of peaking out. But the market also had a relatively high skew, okay, prior to the sell side activity occurring. Could be something interesting. You can also see an extremely high skew right back here, okay. What was the market doing at that time? Not necessarily selling off. In fact, if anything, the market was actually recovering at that point. Okay. Once again, here's an extreme level of skew. This was, in fact, indicative of some sell-side activity before, of course, the market bounced back to the upside. So all I wanted to do is spend a moment and, you can't necessarily say the second that skew is high, it means that the markets are going to sell off. So I went back over a pretty vast amount of time over here. And again, you can even bring up like a 10-year, 10-year monthly is a little bit much here. Let's go to a 5-year, okay, 5-year weekly. And again, look at high instances of skew back in that time frame over here, okay? And if you look at it again, there's not enough statistical data to make this definitive, meaning like, you got 6 or 7 occurrences that skew has ever even really been at this level, okay? There's the bell. 6 or 7 occurrences that skew has ever been in this level. Sure, about 5 out of the 7 occurrences we did see sell-side activity. That does not necessarily, okay, have cause for concern per se at this point, but it is evidence that at this point in time, yes, traders are most definitively, okay, doing what they need to do to mitigate risk. To cause skew to exist, they must be out there, okay, ultimately buying puts on the SPX and likely financing those puts with out-of-the-money calls. So there is evidence that that is what's occurring right here, right now in the marketplace. Okay, when I say there's not necessarily cause for concern, this doesn't mean that sell-side activity is going to be imminent. Okay, at this point in time, listen, we've been looking for a sell-off to occur now for months on end. Have any evidence of it? Hey, listen, we're in overbought territory. Come on, I can bring up an SPX chart and I can show you over the last 10 years. I'm pretty sure that's overbought territory, right? You can bring up every technical study you want. Hey, I'm sure some of you have cyclical studies for 20 years that'll show you that you're in overbought territory. Nevertheless, okay, it's never just a coincidence when you get something like skew relatively high. The cause for concern, all right, is that, again, the area of skew is very definitive. It's not looking at some technical study, all right, where you can ultimately come up with a number of reasons that technical study might be displaying overbought or oversold. Okay, the skew is traders buying puts out there. So we take it fairly seriously, and at this point in time, we're looking for any other evidence on the screen that some sell-side activity may be imminent. However, at this point, I'm not really seeing it. I mean, one area today that really definitely caught my attention was the fact that the bonds got bid up, okay? But until the bonds get clear into the 155, all right, these things, the bonds are ending up at 152. 3 points higher, you may have me convinced that a sell-off may occur, okay? So the bonds are one area I would continue to look at to see if there's going to be sell-side activity. Another area, okay, we look at this very, very often here, the VVIX, the volatility of the volatility index. It is not at this point being bid up, okay? The VVIX is trading at the 85 level. If you see the VVIX, okay, and this is going to be a reach here, above 100. Now, a 15-point move in the VVIX can happen legitimately overnight. And there's a lot of different occurrences where you've seen vast moves in the VVIX. Want to see the VVIX over 100. We need to see the bonds cruising back up to the 155 level. Okay, then and only then would I really start to take this reading on skew not just more serious, but at that point, sell side activity is imminent. Something to think about in the days to come, as this week there's not a huge amount of news out there. I am sure that some of the politics and tweets are going to play out, maybe wreaking havoc, all right, on some volatility on an intraday basis. Nevertheless, key into it, okay? It's a high skew. Again, it's only happened a handful of times since the skew has been measured over there. Again, it doesn't mean sell-side activity is imminent. Nevertheless, it does mean traders are moving cash, okay? And what they're ultimately doing is taking a degree of a defensive position. think about it in the days to come. Thanks everybody for joining us at TheoTrade. I'm Don Kaufman. Be back on all this week in the TheoTrade chat room. Have a great evening, everybody. Bye-bye.